Hello, it's great to have everybody with us. We'll just give a minute as the Zoom filter is working on everybody in the room. Thank you for being here. Hi, Javen, Pedro, Luciano. All right, everybody's firing up. Ramin, familiar face. Good to see everybody. All right, just looking at that Zoom number to stabilize. Okay. All right, we're going to get started here. So thanks for being with us today. This is the fifth installment of the SpotGamma Sharpen Your Skills sessions. This is actually a blended session. It is targeted for subscribers, but we will be doing an intro at the beginning with Brent walking through how Trace works and making sure everybody has a good overview before we take questions and get into examples and look at what's happening in today's market and all the fun things that Trace unveils around the S&P. Before I kick it over to Brent, again, this is our fifth installment. For those of you that are subscribers, all of the previous sessions on our other products are available on the dashboard under the resources tab, or all of these are available also under spotgamma.com/sharpen your skills. I'll drop that in the chat. So all within maybe 24 to 48 hours after we complete these sessions, those will be uploaded. For those of you that do have a lot going on today, the spotgamma.com/sharpen your skills will have these training videos. But if you want to ask questions, be live, be here with us. We're glad you're here. We'll go through all of this now and show you how Trace works. For those of you that don't know me, I'm Matt Fox. I'm CEO of SpotGamma, and Brent's our founder and our fearless leader. So I'll turn it over to him to do the overview on Trace. I'll be here on the chat also answering questions. But again, thanks for being with us. Brent.
What's up, everybody? Good to see y'all. Bring up the old screen share. And thanks for the introduction, Matt. I can tell you that I am actually scared of many things, like bad market data. Always very scary. All right. As Matt mentioned, we are going to talk about Trace today. So Trace is going to be focused, the focus of this conversation. We've done a bunch of other sharpen your skills sessions, and so this one on Trace is one. Trace being one of our marquee tools, being one of the things that SpotGamma subscribers most heavily utilize. And then if we have a minute here at the end of the presentation, I'll gladly share what's happening in the market right now because it's a great example of how Trace can help everyone parse the real-time data. First, everything that we say here is not investment advice. Consult a financial advisor, et cetera, et cetera. So why do options volumes matter so much? You SpotGamma OGs out there will know that the options volumes have gone crazy over the last couple of years, and the volumes continue to grow. In fact, just this past Friday was one of the largest zero DTE days ever. It was an article, a little post on Zero Hedge that said that it was the largest notional traded for zero DTEs ever. So, we just keep seeing more and better and bigger and higher. And, for those of us that track options volumes, that's great. Now, why is that great? Because the more options volumes that come into the market, the more impact we think that options have on the stock market. And obviously, if we're able to analyze and understand where all the options volumes are and where all the positions are, well, that's great for us, right? So on your left here, just to put this into context, is the options market volume. It's up about 150% from 2020 till about a month ago is when we snapped this data. On the right, you can see the equivalent in stock volume. It's only up about 30%. And I would argue a chunk of that 30% gain in stock volume is due to hedging flows. And we're going to talk about that here in a second. Obviously, April is just a banger or fire, I think is what the kids say these days, and of options volumes. Massive options volumes throughout all that kind of terrorist liberation day spasm. So that is the key thing to frame this all with, right? Huge options volume, hedging flows tied to those options positions is what becomes leads those options flows to become a driver of the stock market. Now, at SpotGamma, we coined this term called positional analysis. Most of you are familiar with technical analysis, sort of like, let's see where the Fibonacci is and the moon setting and the moving average, or the 8 crosses the 5-day or whatever it is, right? That's technical. Fundamental, how many cars is Tesla going to sell this year, or AMD didn't sell anything, so the stock is way down today. But what we do is positional analysis. And what that is looking and seeing where big entities are positioned, in this case, typically market makers. And then we try to forecast how those flows, right, those big positional flows are going to shift, and that's going to drive price action. And the great thing about doing this in the option space is we have all of this data that tells us exactly where the positions are, right, open interest, and we can use options modeling like advanced kind of Black-Scholes type equations to understand how these positions are likely to change in value and how the hedging flows related to these positions will shift. And that gives us this insight that we have into positional analysis to help us forecast market direction. So before we get into this, before we get into trace, there's one important concept to understand here, and that's the idea of positive gamma versus negative gamma. Now, positive gamma, when you have a positive gamma market, it means that market makers are going to trade against price action. So if the market starts to rally, what do? They sell stock. If the market starts to sell off, what do? They buy stock. And so when they do that, and if their positions are big enough, what is that going to do? It's going to contract or constrict how much the market's going to move, right? If you ever played one of those like finger traps, like the harder you pull, right, the less movement you have. And it's sort of like the more hedging flow you have, well, the less market can move in a really heavy positive gamma environment because those flows are selling the highs, right, and buying the dip. And that, again, keeps volatility tight. It keeps realized volatility tight. Now, the opposite part or the opposite position there is a negative gamma position. And in that situation, what happens is dealers or market makers, they're chasing price. What does that mean? If the market starts to rally, it means I have to buy stock as a market maker to keep up. My hedging dictates that I have to buy into higher markets. So if I have to buy a ton of stock into a market that's rallying, the market's going to rally faster, right? That can create volatility, upside volatility. Same thing to the downside, right? If I'm in a negative gamma position and the market starts to crash, I have to sell futures or sell stock to keep up. And if I'm big and I'm doing that, you know, every whatever 25 bips the market goes down, I got to sell another tranche of futures. I'm going to accelerate that downside with my hedging flows. So those are the two distinct patterns that we're looking for when we go into look at trace: positive gamma versus negative gamma. Now, one thing is important to kind of understand here, and if you're interested in sort of understanding a little bit more about this, we have a great video on the OPEX effect, excess returns. You can look at dealer hedging flows. There's a teach me like on 5 video there. If this gamma thing, if you need a little more color on that. But understand, negative gamma drives volatility, positive gamma contracts volatility. So what does this have to do with trace? Now, as we explain how trace works, what you see here is a heat map. Red in this case is selling flow or high volatility areas of the map. Blue is buying flows or lower relative volatility on the map. And so if you can read a map, you can use this tool. What's actually driving the trace heat map is market data that comes in, and then we analyze and process that market data, and it informs us what buy-side entities are likely doing. Who's buy-side? Hedge funds and retail traders in particular. And we focus on that flow because we believe those are the flows that have to be hedged by market makers. So what we're showing you is the market maker depiction of what they have to do. So that shows up as red and blue on this map. And then on the left, you get these bars. And the bars are showing you the specific strikes, puts in orange, puts in blue, calls in orange. And that's showing you where the biggest positions are in the day. And you can toggle this and do a couple of other settings. But at the end of the day, what you're seeing here is support and resistance via the heat map, estimates of volatility via the heat map, right? Like how much should the market move? And then the strikes on the left are giving you specific levels, right? So you can look at those as specific support and resistance strikes or levels, okay? So on this map here, 5,500 is a huge level, and then to the downside, 5,400 is a huge level. And what do you see? The market moves through here. All of a sudden, the map turns more blue. It finds support, and then we rip back through this zone of high volatility, right? So it's very simple, even if you don't want to get into the logic of, okay, like what is the market maker doing? Don't quite understand. Oh, okay. Blue is support and resistance, red, high volatility zone, easy. So how do we do this when we break into this a little bit more? And there's a couple of extra settings in here and we talk about supercharging your trading, but when you look at the S&P order flow right now, the last about month, over 60% of SPX index options volumes are tied to 0 DTE trading. And so what you see here in the map on the left side is we have this setting called 0 DTE, and you toggle that back and on and off, and that shows you where just 0 DTE positions are or where all positions are. Now, what's interesting about Gamma is highest for at the money options, and Gamma increases as we get closer to expiration. So what does that mean? That means that 0 DTE options have the most Gamma. That means that 0 DTE options are likely what is in most control or has the highest impact on the SPX order flow or the way the SPX behaves over the course of a day. So with that, I would say that if you trade futures, if you trade spider options or stock, if you trade S&P options and you're not watching the 0 DTE order flow, you are missing 60% plus of the picture, right? So what you can do here, and what you see here is a couple of different things, right? You can toggle some models. We show you either delta, gamma, or charm, and all of those are related, right? But they're all showing you support and resistance zones. We give you this color heat map, and the reason that the heat map is so powerful, obviously, is because you're getting a statistical inference of how important this data is. Options trade all day long in all names. So if you don't have a context for how big or small that particular position is, then you kind of don't know what you're doing, right? So anytime you hover over the map here, or you see a higher or more intense color, you're getting the data that says, hey, guess what? This is like a 99th percentile. And if you're a SpotGamma subscriber, you know I'm always talking about the 99th percentile strike. You're getting an understanding statistical, I can't say that word today, statistical significance of how important that is. Because obviously, look, if you're looking at a position, you're saying, wow, look at this position here, it stands out. But that's like one of the smaller positions we had in the last 2 weeks, then it doesn't really mean anything, right? We also overlay our key levels onto this heat map. And then there's this time slider. And the time slider is cool because you can go back and replay what happened. If you ever look at some of the best traders in the world, they do that homework, right? Market closes. It's kind of like when you're a professional basketball player, it's like, you get, you become a champion, they say, in practice, right? And shooting 1,000 jump shots a day or whatever. It's like, well, if you want to go back and see what happened in the day and like, how could I improve that trade or what signal did I miss? You can replay the map and see exactly what happened. And what's fascinating is a lot of times the biggest jumps or biggest position shifts on the day, right? Time to or sync with an intraday SPX position being closed. So in this case here, again, you see the OI by strike. The time slider allows you to go back and forth. Now the map updates every 10 minutes intraday. So every 10 minutes, the bars on this chart may change if positions changed. And then the heat map is adjusting up and down, obviously, as the S&P 500 moves, and then obviously as positions are shifting. So I want to go back one more slider because I think this is a little bit easier to explain a little bit extra about how the map is working. What we're doing here, and this is a moving picture, but what we're doing here is we're saying, what does the gamma look like, or in this case, the delta? So let's just say this is the gamma map setting here today, but what does the position look like if the S&P rallies higher? And so you can see up here, it's red. What does that mean? Well, that means it's a higher volatility zone, or if you're looking at this delta map, it means that there is more for the dealer to sell, right? So it's a projection on what happens if the market rallies up higher, right? What happens if the market declines right here? The bright blue tells us that futures may have to be bought. So the closer we get to this downside, the more blue the map gets, is a inference of more dealer hedging flows coming into the market, right? So we're projecting higher and lower in price, what happens, and then also what's happening over the course of the day. Remember I said before, for 0 DT options, gamma is highest for at the money options, and gamma increases as we get closer to the end of the day. So when you get to the end of the day, you'll often see colors that get to be very intense, like here, because a 0 DT option has an extreme amount of gamma at 4 o'clock, right? But that's only relevant if you're near the strike, right? So if you have a ton of positions at 5,500 and we're closing at 5,400, well, obviously that 5,500 strike has no gamma, right? It's super far out of the money. With a minute left in the day, it doesn't have any value. So the map is projecting, right, these if-then scenarios in real time of what happens if the market rallies, what happens if the market drops, what happens as we go over the course of the day. And this allows you to forecast, again, how those hedging flows are going to come in and impact the market. So let's check out a couple of examples here one of the most interesting things that has happened was in May. And I know that's about 3 months ago now, but it was such a fascinating example of driving order flow around a big news event. And oftentimes, especially if you're in the macro space or you're a fundamental or technical guy, that's how you look at the market, right? It's through that lens. And when you're a macro person in particular, it's sort of like you have an event that takes place, but you can't really tell us how big the order flow was. And if you're technical, indicator, it's like this line crossed this other line, so that means something happened. But with the options order flow, we can tell you in real time, right, how many positions are left. What was the actual dollar impact of that position that shifted, right? So there's not really like guesswork with that. You're actually seeing the data on the screen. You're seeing what the positions are, et cetera. And so the reason we love this example is because many of you may have seen this before if you're a SpotGamma subscriber, but if you're new to this, this was the day that there was an allegedly failed treasury auction, or very poor treasury auction at least. And right here is where that treasury auction took place. And the bond people said it wasn't that big of a deal. Equity people said it has to be a big deal, but the market definitely dropped at that exactly at auction time. And what caught our eye was this really big position at 58.75, and you can see it here. There's over 9,000 zero DTE contracts at that strike. And this was something that we flagged in the morning note because we looked at Trace and we said, hey, this is a pretty big position. Again, you can see it, 99th percentile strike. And when you see a 99th percentile strike, what that is really telling us is there is a lot of liquidity in that zone, right, or at that strike. And if you've been trading for a while, you know that the market tends to move to the biggest pockets of liquidity. It's just like a big magnet, right? And sometimes that liquidity is higher and sometimes that liquidity is lower, but the market tends to be attracted to that liquidity. So in this case, what happened is you get this weakness. And if you're looking at this map, this is the gamma map, what you see above here, right, is negative gamma. Negative gamma all in this huge zone. As we've said several times here, red in the gamma map means high volatility. What does that mean? The market should move fluidly through this level because it's red. And then where does the map turn blue? Where should it be supported? Right here, right? 5780. Excuse me, 5880. So what you see here is we don't know what's going to happen, right? At the moment this treasury auction takes place, no one knows if the treasury auction is going to be good or bad or how the market will react to a good or bad auction. What even is a good or bad auction? Turns out macro people don't know. But what I do know is if then, right? If we get some weakness, there's a lot of room for the market to drop because of this negative gamma position. And there's this huge liquidity pool, so to speak, at 58.75. So you can put these two things together. Market gets weak. Looks like the auction was weird. I know I have negative gamma below. I know that the only major level to the downside is that 58.75. I also know that that 58.75 is the driver of all of this negative gamma, right? This is what the data is telling me because this negative strike here tells me the market makers are short these puts. I know there's zero DTE contracts and I know there's 9,000 of them. So I have a target strike, 58.75. I have the red gamma above tells me that the market's fluid through there, so I can put those two pieces together. And then I was given a trigger. Didn't know the trigger was going to come, but I was given the trigger in the auction, and down goes the market. So I could put those two things together. Now, the second one is, okay, let's say that I didn't catch this drop, right? I wasn't positioned before, but now that I have the drop, when do I want to put myself in the market? When do I want to think about buying the dip? Or if I was fortunate enough to be short, when would I think about covering that short position? How do I then take a position, or how do I then react, right, to the decline? Well, look what happens here at 58.75, right? The market hits that level, it trades just through it, and it bounces at the blue area on our map, which is right here, right? That blue area really didn't change from 120, and this is 240, right? So there's a pretty good amount of time that shifted here. That blue support zone was the same position there. So that was one excellent sort of guideline. But then what happens in real time? Because again, the positions update every 10 minutes. What you see is right at this time, and we did an actual video of this, so you can play this back in real time. If you're a SpotGamma subscriber, you can actually go back to this day and replay this day if you'd like to. You'll see right here, the trader starts to close their put position. So the dealer at this moment right here is short 9,000 puts. Doesn't like that, right? They got to hedge by selling futures. They're behind. They got to catch up by shorting. And then what happens is when the market collapses into that strike, the trader who was long those puts, probably pretty happy about it, starts to close that position out. And the result of that closing the position out, you can see that here's a full blue bar. I apologize, it's a little tough to see. But here, right, the blue bar is only that big. There's a big kind of naked candle there, a big wick, I guess they like to call it. So when that trader starts to close their position, the dealer can start to buy back their short hedges. And what happens? The market bounces, right? And that's the low of the day as they close those positions. And you can go back and tick for tick, you can even break this down by looking at time and sales on the day and see exactly when they close that position to the second. And that is what exactly supported the market. Now, if you didn't have this data, you would, number one, 58.75 would be of no, would not be in your sort of psyche at all, right? If you didn't know that was a big options position. Number two, if the market started bouncing there, you'd be like, why are we bouncing? And then you would, I need a narrative here, right? Oh, maybe the auction wasn't so bad, or I don't know, someone tweeted blah, blah, all nonsense, right? Because you can timestamp, like the kids say, we got the receipts. This is where the position got closed. This was the position that was called out before the market opened. You could see the position there the whole time. You could see the position being closed in real time, and you can see that's where the market starts to bounce. Not only that, we tell you it's a 99th percentile position, so you know it's one of the biggest positions there is. So you got the statistics, you got the data, you got the everything, right? Not some lucky forecast. It's like if-then statement. If we drop here, that's the 99th percentile strike. It's the big magnet. If they close that position out, guess what? That position starts to relieve the pressure on the market. So here's a couple of other recent examples. Now, we've talked a lot about this idea of gamma, right? Gamma is a way of telling you how much delta hedges have to change as the stock price moves around. But there's another interesting metric that we have here, and it's called charm. Why does charm matter? Because charm tells us where the price pressure is specifically for 0DT options in particular going into the end of the day. Now, charm is related to time decay, and as you all know, 0DT options have the highest level of time decay, particularly when you start to get in the end of the day. And so what's valuable about the charm map is that you get these very intense flames, right, of red and blue, and that's telling us where the buying and selling pressure is heaviest related to time decay. And so you end up with these equilibriums all the time, where here are the big 0DT positions. This is where the S&P is trading. And when you see dark red here, selling, right? Red sell, high volatility, etc. Blue or purple, buy, support, easy, map. And what happens? The market finds that equilibrium. And you see this type of thing happen all the time, particularly when you look at like a Captain Condor position, for example, where that time decay, right? It like guides you. It's like a funnel, it kind of funnels you in. Why? Because that decay is getting more intense in the end of the day. There's more to sell above, there's more to buy below, and you kind of end up sandwiched or funneled into these price levels that have the giant positions. And so, again, you can go back and look at big positions historically and see exactly how this works, but you'll see this kind of pinning flow all the time. And the cool thing about this is that it allows you to set up really interesting trades. Call flies or put flies in the 0DT space where the risk reward can be really phenomenal. You'll pay maybe 50 cents or $1 for SPX spread that might make you $10 if you're right? It's a really great positively skewed return around a lot of these trades. And also if you're trading in futures and you're like, hey, what's my price target? Should I expect a 5% rally or a 1% rally or a 10 handle rally? Well, if you know that the hedging flows are kind of dictate the price action, then you can sort of step in and say, okay, I'm going to take a short swing here, try to get 10 points, right? 10 handles in S&P, and that's all I'm looking for. Whereas if the map is saying no, like we're wide open to the upside, well, then maybe I'm going to go for like a 1% rally, right? So using this data can really help you to manage your risk, set up effective risk reward trades, and then take advantage of all those positions that are laid out. Now, for those of you who are SpotGamma subscribers, we love you. We talked to a bunch of you yesterday, 2 days ago, I guess, in the SpotGamma Q&A, and we'll be back tomorrow with the Q&A, and we really appreciate all of your support. If you are new to SpotGamma, we recommend you check out Alpha. Alpha is the membership that gives you access to Trace and a bunch of other tools that we did not talk about today, including HIRO, which is one of our other marquee tools. But if you join in SpotGamma today and sign up for Alpha, you'll get the daily notes that we mentioned before. You get access to HIRO and a bunch of other tools that help you to set up nice swing trades or other things in single stocks. You get access to Trace, which we talked about today, and then all of the Equity Hub. Equity Hub's been updated with our SpotGamma open interest. It's our kind of, we call it our synthetic positioning. So that's our custom buy side positioning in all US listed stocks. And that just gives you the most complete picture there is. As far as I know, we are the only group that has this data, right? Has all of this data across all single stocks that tell you exactly how hedge funds are likely positioned. And that just gives you a tremendous amount of edge, right? And that's why we are all here. And so please go and check out the Alpha membership. Matt, I know you have now popped back on, so I will pass some time to you briefly before I take some questions.
Okay, thanks, Brent. So there are hundreds of you on here, which I'm really excited to see, just to have a balance. This is our fifth session again of Sharpen Your Skills. So Brent's going rather quickly through the overview of Trace. Some of you have said some parts are confusing or trying to understand how things really work. If you go to, and I put this in the chat and I'll put it again right now, it's www.spotgamma.com/syllabus. This page has free open tutorial videos on how to use any of our tools, and there's a section on Trace, which we'll walk through again. We went with a very simple color scheme of blue good, red bad. So in the gamma lens, more blue means less volatility, steadier markets. More red means higher volatility. On delta pressure, that's a directional indicator. So when you see the blue, there's more buying pressure, and the red is more selling pressure. And then the third lens of charm really helps into the close at the end of the day. I like to use that an hour or two before the regular hours close, 2 to 3 p.m. Eastern, where you can see how Trace is starting to zero in on a certain level, usually between a blue and a red zone for the close. And that again can help, as Brent said, doing different closing things. I think Victor just helped if I had a typo as I misspelled the word syllabus as I'm talking. Thank you, Victor. And then also for all of our videos, you can see those related to, if I can spell the word sharpen your skills properly, this will be posted along with all the previous videos are up there from other sharpen your skills sessions. So Brent's now going to take the questions that are in the Q&A box. If anybody has questions, please put them in. Brent, a couple that are shorter came in as you were talking, so you may need a little context what it means. But there's 4 or 5 questions in there now. If people have more questions, please populate them. And then Brent, you may want to start with a live look and then go to that, or either way, your call. But thanks for being with us.
Yeah, thanks everybody. So I know I tend to go through things a little bit quickly, and we also sort of lean on the fact that you may understand Gamma pretty well here. So I will go through the live chart now and just show you how they'll use this chart in real time. This is something we do a lot in the SpotGamma Q&As, and I'll make sure to get all your questions, but we could talk about it in real time, right? So Jay, first, let's be clear about the zero DTE toggle. Jay says he doesn't understand the toggle. For example, at 63.50, there's 63 million in positive gamma on the calls, and if you toggle off the zero DT, the numbers change. Okay, so let's talk about this toggle. When I toggle this back and forth, you'll see the positions change quite slightly, right? What is this doing? If I turn zero DT on, it's only showing me the gamma, that is the gamma, the GEX positions in this bar chart for zero DTE only. Remember, zero DTE is almost all of the positions in the S&P on any given day, right? Not always, but on a typical day, kind of boring, low-key day like today, it's going to be most of it. Why? 60% of the volume. And gamma, again, highs for at-the-money options as we get closer to expiration. So if you're looking at the gamma space, most of the gamma is going to be zero DTE. When I turn off the toggle, you will see that the at-the-money positions, that is the positions around where the S&P is trading, which is right here, it's these candles. You can see right here, right? Almost all of that is just zero DTE. How do I know that? Because the map doesn't change when I toggle it back and forth. Zero DTE on, these are all the positions. I know there's zero DTE because that's what the time is on, or the setting is on. I turn it off. These positions hardly change. Why? Because most of the gamma is related to zero DTE. If you look here at the out of the money positions, these positions have more gamma. They have a little bit longer to expiration, right? So you'll see those out of the money positions actually have gamma associated with them. And the reason that to me is important is because zero DTE positions matter for today, right? They have an impact on today. The shift of those positions matter for today. If I know the position or the market is being influenced by positions that don't expire for another 2 weeks, I take a lot of different information from that. Let's say that the market started crashing today because someone bought a bunch of puts, but they're 0DT puts. Well, then when the market closes and those positions are gone, then the pressure should be gone, right? It should be alleviated. However, if it's someone bought a whole bunch of puts that expire in 2 weeks, that pressure is going to be there for another 2 weeks, right? Because that's persistent hedging flow. Those hedges related to those positions don't go away for 2 weeks. Make sense? Hopefully. So, Jay, it's a great question, but that's what the difference is, right? You toggle this on and off, and the bars over here adjust only to that setting. The map itself only ever shows everything. So it's incorporating the fact that it's 0DT positions in there. It's incorporating the fact that there's all expiration flows that are in there, right? But the heat map is going to adjust related to what the flows are. So it's sort of embedded that 0DT is the most important in the map because those are the positions that have the highest gamma, for example. So Matt had mentioned charm, but let's just go back to the gamma map and look at what we see right now. I mentioned earlier, right? 99th percentile strikes are the most important. So if I hover over this position right here, what do you see? 99.05, that's in the last 30 days, that's one of the biggest strikes there is. So that's the 63.50 strike. It has $81 million in gamma at that strike. And look what's happening just below it. That's a 98th percentile strike. It's not 99th, but what you can see here, and if I zoom in a little bit on this, you can see that some of the position has been closed, right? See this right here? So if I hover over this, I can see an hour ago, it had 67 million in gamma. Now it only has 38 million in gamma. Why? Somebody closed the position up. So when the market was rallying into this area, you can see that was the biggest strike on the board, 99th percentile gamma. And then what happened here is we edge a little bit forward. The market topped out. Somebody sold a bunch of positions, here. In other words, this gamma strike grows, and then someone starts closing this one. So it looks like what they did is they rolled up. See that? And coincidentally, in this time, the market starts to top out as that 63.40 gets closed out. See that? Positions right here. We hit the 99th percentile strike. This one under here gets closed, and you see the market react by selling off. And you see this kind of thing happen all the time where the biggest positions, right, they'll get closed or moved, and then the market has a reaction. Now, it's not a 50-handle reaction, but suddenly you can see, oh, these positions are in the driver's seat because when they get closed, the market comes down, right? If the position builds above, that's where the resistance is, and you see that stuff overlay all the time. So if I'm trading this right now, I'm saying to myself, what is my number one sort of forecast or idea or bet here based on the information I currently have? Number one is this is the biggest zone of resistance, right? This strike, again, not as big as it was in the morning, but now this is the 99th percentile strike at 50. I have no reason to think the market's going to go above that level. Now, if Trump announces the best trade deals and a Russia peace deal or agreement, then okay, well, like bets are off, right? Because something fundamentally changed. But all else known, I don't think the market's going to go above that level. So if I'm long futures here, you know what I think I get 5-handle rally out of this thing, right now. If I'm selling call spreads, well, I'll think about selling them up here, but I'm not going to sell maybe in here or below this position, right? And do I want to be short this market at the moment? Well, what do I see around where I'm at? It seems like the market's pretty well supported in this zone, right? The map is blue all the way in this zone or purple. And if I break below this area, 63.25, you can see the map gets red. So I would be interested in shorting if we got down there because the red map suggests negative gamma. What does that mean? That means if the market starts to go down, then market makers will start to sell. So market makers are buying, a little bit less and less and less, and then here they start selling. They get more aggressive seller, more aggressive as we go down. So at the moment, what am I thinking? I'm thinking we're probably just going to tread along this line with this being the high. Now, Matt mentioned the charm map, right? Number one, well, not number one. You can see gamma, the highest or brightest area of gamma on my map right here is this spot tied to the 63.85. So that is my big target for where this thing is most likely to close or where the resistance is most likely to hold. If we flip to the charm map, which is again related to the decay of the market, what do you see in the current map? Well, you see that as the positions decay throughout the course of the day, right? As this position and this position decay, there's more intense buying as we get into the close, right? So the market should have better support over the course of the day based on this map. And as we get into this area towards the close, there's some pretty intense selling. So the best trajectory that I have for what the market is likely to do based on current positions is something like that. So if you're going to express this as a trade, it would be like selling the 53.45 straddle or something like that. I don't know what the prices of those options are, so please don't go and do that trade. You also want to make sure you're getting paid the right amount. But that's the trade expression of what, in other words, this thing likely just a pin, as the charm map is telling me there's big buying below, and then as we get into the close, there could be some decent selling, and we kind of just pin this level. Now, if this position is closed or moved, the map is going to change in real time, right? And that's going to kind of upset the trajectory of what is likely to happen. So that's an important thing to take note of. Does it matter whether the 99% is red or blue for acting as a magnet? So it's a great question from the dude. This is a 99th percentile position. Lately, in this more relative calm market, most of the positions tend to be blue. What does blue mean? Positive gamma, or purple, positive gamma strike. That means that somebody sold the call or sold the put, right? So if I had and I could toggle and look at that, but that positive gamma is like a pinning strike. If it was a negative gamma strike, in this case, like this one, then you would see that somebody either bought a call or bought a put. And in theory, that should move volatility around. Now, for purposes of this conversation, I think that those 99th percentile strikes are liquidity magnets, and the market tends to move to those levels. Now, once we've hit the target of the 99th percentile strike, then you have to sort of figure out, okay, are we likely to pin, or will that position get closed and shifted? If it's a blue magnet, then I think we probably hit it and then pin, right? So that's the idea. But if this was red, right, then I would look at that as a support or resistance level, but I would be much less apt to think that the market's going to pin to that strike, because there should still be a lot of flows around it. So in other words, 99th percentile in blue means hit it and pin, and then it's red, it's sort of like hit it, and then that's the trade is off, right? Because we have to assess what happens kind of after that, if that makes sense. Now, some of you are probably saying, Brent, how do I know whether that's a put or a call? If we hit this toggle and we go to net OI, we can actually see what the position is behind the gamma. So what you're looking at now is net open interest. So what specifically is the position that's driving that gamma? If I hover over this, what we see is the gamma is driven by call positions. So 0 DTE net call position is 5,400 contracts right now. And that is about the highest of the day. As you can see, about 10 minutes ago, it was 5,700. So it's a little bit smaller than it was. But that's telling us the contracts. And the fact that it's orange, as I mentioned before, means it's a call position. Blue is puts. And so you can see really on down here throughout the whole position is a lot of dealer put positions, right? Everything below. Now, the fact that these contracts are on this side and they're negative means that the market maker is short those positions. So if you're looking at this, what does the dealer have on right now? The dealer has on long calls, right? That's why these orange bars are to the right of this chart. So they're long these calls. It's a positive gamma positions, but they're short all of these puts. That's a pretty interesting position. Why? Well, some may call that a risk reversal or a combo, right? So if I'm short the call and long the put, what this kind of infers to me is that if something does go bad, like a trade deal or something like that, and you start to break down a little bit, there are some puts down here that I'd have to worry about, right? And so if we just go back to the gamma map and see what that looks like, remember below we said, okay, up here the market's pretty well supported, right? Low volatility. And if we broke, say, this 63.25 area, the selling gets bigger. Well, why is it getting bigger? It's because of these put positions, right? The dealer's short a lot of these puts. So that is the risk of, I don't know what happens today, right? But if this happens and the market slides lower for some reason, then I really have to worry about it if we break that level. Do we ever slice through a 99th percentile gamma bar? Of course, you can slice through those gamma bars. You know, nothing is guaranteed. And a lot of the way that you can figure out if we might slice through a bar is by using HIRO. HIRO is a separate conversation from the Sharpen Your Skill session, but HIRO is on my chart here as this purple line. So when do I get worried that we may blow through this strike. It would be if HIRO continues to do this, right? Because HIRO is telling me that new positions are coming onto the market that pressures the market higher. Again, that's a different session, so I don't want to gloss over that too much. But in trading, everything is statistics, right? Odds are XYZ doesn't ever happen, or 9 out of 10 times this happens, that kind of a thing, right? So there's no never in trading. It doesn't always happen the same way. But as a guiding principle, I believe that these positive gamma strikes hold the market in when they're that large. In fact, those of you who are SpotGamma subscribers know that yesterday we were very clear, so I'll just show this again, talking about the big position in the market yesterday, right? 6350 resistance, 6300 support from a 0 DTE position. We call them Captain Condor. And so you can see there's the big position to the upside. Futures touch this overnight. And then this is the big position to the downside. Right? So this is 7:30 in the morning, we put this note out. Watch those positions. So what happens yesterday, I can show you in the map. We go to the 5th. Market is very weak at 9:30. As you can see here, there are those positions, right? Right here is the upside, right here is the downside. These are 0 DT positions. Remember, if you don't quite understand gamma hedging, delta, all you need to know is support and resistance, right? Where are the big strikes? That's the target. So what you see is the market opens right here. The hedging flows are negative. Again, here I'm not supposed to be covering on this topic, but just watch that purple line go down, and this is the target, right? This is 62.95 specifically, and the market just goes right down to that level, and it stops. There it goes, right? And if you didn't know that massive position is there, right? Again, look at what size it is, 99th percentile. If you don't know that massive position is there, then you don't know the market has huge support there. You may have been sucked into a short thinking like, oh man, it's over. I don't know what it is, but it's over, right? But instead, what we do, we hit that position. The position's there all day long, and guess what the market does? It just bumps along that position all day long. And I can tell you that, a lot of times you watch a presentation, you go, oh, hey, this is some chart from 6 months ago or 2 years ago or whatever. It's like, you can see this happen on a daily basis. And if you don't know much about Captain Condor, you can Google Wall Street Journal, SpotGamma, and Captain Condor, and there's a whole article about this 0 DT strategy that's often in play. And so, here we go. We forecast back to today. Well, that's the big position, right? That's 6350. And as long as that position's there, then I think the market is probably pretty capped by that, right? I don't have a reason to short it and think we're going to crash. Do I want to sell a cheap call spread up here? Maybe. I don't know what the price is. I don't know what the risk reward of that is. But all else equal, just kind of doing one of those is what I would think would be the odds-on favorite. Tina asks, how constant are these supports over the day? How precisely can you prospect them at the beginning of the trading day? There's two things, right? Number one is, so if we look at the map for today, you don't know if there's always going to be a 99th percentile position in the market. Typically every day there is, right? But like in April, for example, things were so active, there would be a 99th percentile position there 1 minute, and then bam, it's gone, right? Why? Because someone bought a bunch of puts, market crashes, they close them, market rips, and it's just ping pong, right? When like a guy like Captain Condor comes in, he comes in the night before actually, and he sells an option, so we know when he'll be there. But if you look at the start of the day here, for example, there's no 99th percentile position, but 60% of SPX volume is 0 DTE. So at some point positions build, right? And they tend to build around where obviously the market is trading. So oftentimes on a day, you'll see, okay, no big position necessarily to note of, right? But then what happens? The market settles in. Maybe there was like a data point that got released. We sort of set up the context of the trading day, and then you see those positions form. Why do those positions form after the market opens? It's because once the market opens, then you have people come in and they sell some calls above and they sell some puts below, and we start to build that gamma position up, and the position gets a little more mature, and then you start to really see how things likely play out, right? So to answer your question, I would say 1 out of 5 days, there's a start of day 99th percentile position, and then like 4 out of 5 days, at some point you'll have a 99th percentile position layout or set up over the course of the day. Should one use Trace for scalping futures, or is it better to go with HIRO or a combination of both? I think you can use Trace to scalp futures or set them up as targets, right? So if you're bullish on the market and you need a real price target above, right? Okay, where do I think the market could rally to? if I am right here, right, or even right here, where should I sell? Do I sell here? Do I sell here? Do I sell here? Do I sell here? Right? Well, there, right? 99th percentile. Why? When the market rallies up here, flows should change. And what HIRO is doing, and I don't want to get off on the HIRO tangent because this is about trace, you'll see HIRO adjust at these levels that backs up the idea that it's a support or resistance level. So the combination of both is extremely powerful. That's why we offer HIRO built into trace, as you can see here, right? And the combination of both gives you a really clear understanding of exactly how options flows are active in the market. Do we only pin in positive gamma? Yes. I mean, you can have low price action anywhere, but the option flows are only driving the pinning action, right, in a positive gamma environment or at a positive gamma strike. So a blue strike, blue, low volatility, or some people call this purple. If I really want to get people upset, I'll keep referring to it as blue. It really gets people upset. Blue or purple, pinning, low volatility, right? Red, high volatility, lots of movement. Luca, what's up? In Charm, the negative gamma increases. So when we're talking about the Charm map, right? What we're showing you on the map is the Charm, right? It's not gamma on the Charm map. We're actually showing you Charm, which is a Greek. It's a second order Greek. So the Charm, which is the time decay on the day, how is the time decay impacting the market flows? What we're doing with Charm is we're looking to see where we think the market will close, and we're generally going to target where these red and blue areas meet. Why? Because if we have all purple down here, right, this suggests buying as the decay of the day takes place. All else equal, based on what I know right now, those are buying flows, right? And then above is selling flows. Well, if there's buying flows down here and selling flows here, then we should kind of hit that equilibrium. And that's what the Charm flow is of the day. So that's different from the gamma flow, right? Gamma is based on price action. If the market goes down, here's how the dealer should react based on the stock market going down. If the SPX goes up, here's how the market should react, right? Positive versus negative gamma means which direction are they trading into, if you remember this opening chart right here. So on this opening chart, we talked about how dealers hedge in positive gamma. This is where the blue or the purple zone shows up, right? Or if you see a blue or purple strike. Negative gamma is the red. Mike M, hey, how you doing? Good to see you. See your name. Did you hear that correctly? Positive gamma is traders selling calls or puts and the market makers bought them. That's right. So as a trader, to have a positive gamma position means that you own options. Doesn't matter whether you own puts or calls, that's positive gamma. Okay, so a market maker, if they are buying calls from Mike because Mike's selling them, the market maker has a positive gamma position on, and Mike has a negative gamma position on, right? And you would hedge differently. So that's why when you look at the GEX chart, right, we don't break out put or call on here for the gamma because it doesn't matter. You add those two together, right? It doesn't matter whether it's a put or call, you can add that gamma together, but if I'm net long calls or net long puts, I have a positive gamma position. If I'm short puts or short calls, I have a negative gamma position. The hedging is the same, right? Blue is positive. As the market rallies here, I'm gonna have to sell stock based on this, right? On the gamma position. If the market, oh, sorry, I just did that wrong. If the market rallies in here, right, this dictates, right, positive gamma, blue position, I'm selling, right? That's how I would hedge in this positive gamma environment. Why? Market goes up, I sell into that rally. It's exactly what this chart is telling us, right? Market rallies, I have to sell. Okay, market cools off, I buy it back, right? Market rallies, I sell again. Market cools off, I buy it back. If you ever looked up gamma scalping or gamma hedging, right? That's what that's telling you. Now, in this case, if the market sells off, I'm doing the same thing, actually. I'm going to sell into a much weaker market. Why? Because this is red, and I'm directionally trading into that market. Sometimes, based on the map, you could have blue below. It's not always, the colors are not always the same. So if I zoom way out on the map, right, I just made a zoom to the highest possible level. What do you see here? Well, that zone of selling is only through here. So if we had a catastrophic-ish kind of thing happen right now, right, the market makers had selling flow all the way down until about 6,200, and then 6,200, you can see there's a buy zone in here, right? It's a buy zone because it's a stability zone. The market makers should trade into the market at that level. So that's the depiction of if I zoom way out. This is very useful because if you think about a catastrophic market scenario, right? Market might crash, or I'm really worried about risk. If I see a lot of blue down here, then I don't have that much to worry about. If I see a ton of dark red like this, right? Like let's say that this red was right here, I'd be much more worried about the stability of the market right now. Whereas right now things seem pretty stable. And by the way, if you look at this gauge, right? The gauge tells you forward price movement. The higher we go on that stability line, the tighter the price action is. So specifically, this is telling you what's likely to happen over the next about 30 minutes. So if you have a very stable market, 60, 70, 80%, then you should only expect about 5 to 10 basis points of movement in the market over the next 30 minutes. If we get to like 0% stability, then you should look for about 0.5% of movement over the next 30 minutes. So that gauge also tells you how much volatility to expect. I'm on right now. This HIRO is set to S&P 500. You can toggle back and forth between equities and S&P 500. Hey, Alex from Greece. Good to see you. If we have a cluster of negative gamma and they're getting closed at the end of the day, should you increase in price? That's an excellent question. Fantastic insight. So what the question is like, imagine that we had a whole bunch of negative strikes here, right? We kind of do already, but imagine these are really big like this, right? And then imagine that the market tanks. So we're down here at 3 o'clock, right? And this is where we are. And then all of a sudden you see these positions get closed up. If you remember before, we were talking about that 63, 40 position getting closed in the market reacting, right? But imagine we see all these positions get closed up. So the candle's cut in half. I would bet you dollars to donuts so you see the market rip into the close. And the fact that those are 0 DTE positions, to me, makes it more likely that the trader closes the position before the end of the day. So I am always on the watch for big positions being closed, particularly negative gamma strikes, so red strikes being closed before the close. So like if I own these puts, right, and the market tanked all the way down here, so the market did this, I'm up a lot of money probably on those positions. And do I really want to wait the next 20, 30 minutes to see what happens? Probably not. Right? I'm probably going to monetize that position. So what happens when I monetize that position? I take the hedging pressure off and the market gets lifted. Why? Dealer was short put, shorting stock. Brent closes his big put position. Dealer's sitting there, I don't want to be short stock anymore. I don't have a position anymore. I got to buy those futures back. It's exactly what happened in this example here, if you remember, where we covered this happening intraday, right? On that treasury day. Market tanks, huge put position, 0 DTE, trader goes, great, I made money, close those puts, market bounces. Same thing with calls, right? Market's rallying because someone bought a bunch of calls. When they close those calls, we get off time see the market fade. When are market makers likely to hedge? We see the hedges take place oftentimes at these 99th percentile strikes. And I think that is because game is highest for an at-the-money option, and so you have a lot of risk at-the-money options. I also think traders are likely to change or adjust their position when the market hits their strike. But in theory, the two biggest, well, not in theory, when the market opens is one time of big hedging because overnight a lot of positions shifted, right? Market opens, things start to trade, you can adjust a lot of positions. Second time is into the end of the day. There's a likely to be a lot of positions changing as well. So those are the two biggest times a day. And then if we hit the strike, right, then I would expect hedging flows to also increase. Freeman says, can I explain why the historical percentage is different on GEX values versus the net percentile? So GEX is for at-the-money options. So it's sensitive to where the SPX is relative to that strike. Whereas if you're looking at open interest is just telling you what is the percentile of the number of contracts. Number of contracts is just based on how many contracts are bought or sold, right, on net. That number doesn't change relative to what the market's doing, right? In other words, there's 4,500 contracts open there right now, right? The market goes up 1,000 or down 1,000, there's still just going to be 60, or there's still going to only be 4,500 contracts there, right? As long as someone doesn't trade. But the gamma is going to shift wildly over that period because gamma is a function of not only the number of contracts there are, but what is the S&P price doing, right? S&P goes up and down. Aman asks if there's a strike below spot that has a long put and short call, the gamma tends to cancel out. Yeah, so it's a good question. What Aman is basically saying is you could have a situation, right, where okay, there's a lot of positive gamma up here, but there's negative gamma down here. So doesn't that cancel us out? And the answer to that question is yes, particularly for options that are not zero DTE, right? Because when you have a blend of positions that are longer dated, then I'm sort of trading the gamma in a different way, right? I have a little bit of a longer term view. The positions net out a little bit more. The strike space, I'll say, doesn't matter as much, right? If we go up or down 5 or 10 handles, my gamma is going to be pretty stable. But when it's a zero DTE position, the gamma starts to concentrate and you have more what I would call strike risk, right? So think about it this way. If I own all of these contracts, right, but they don't expire until December, then do I really care if the market goes up or down 5 or 10 handles today? Not really, right? Doesn't the position doesn't expire for 3 months. What do I really care, right? But imagine it's 350, right? 350. Market's about to close, and the market is right here. Well, there's, as we showed before, about 4,500 contracts, right? And their P&L, the P&L of these contracts, has a massive swing if the market goes up or down five handles, right? A couple $1 million, easy swings, whether the market goes up or down by that much. So on a zero DTE space, it matters a ton to whoever that trader is that might be short along those contracts where that position closes, right? They're going to be much more sensitive to what's happening there. And so close to the close, it doesn't matter what all that looks like because that stuff is all going to expire worthless, right? But this matters, right? This is kind of everything if you have that on your book, and it's about to expire in 10 minutes. So at which case, there's not gonna be any balancing out of any kind of position. It's like that strike is the one that matters. Anonymous attendee says if a large 99th percentile gamma strike has a pinning effect, what does a negative strike do? So we've gotten that question a few times here, and the difference or the way that I look at it is imagine that we had a negative gamma strike down here, right? I don't think that this position will come into play, but if the market tanks, this is my target. So if I'm short futures, this is where my target is. But once we hit that target, I'm likely to close out my position. Why? Because I don't know if the market's going to do that or it's going to do that. Could do either. If they close the position in particular, it could bounce quite strong. But I don't have any reason to think we pin, right? Just because it's a negative gamma position, we shouldn't pin. So that's great. Whereas in this situation, I think the market's going to go up and pin. Now, if I'm long futures and I sell my futures, then it doesn't really matter if we hit the target and then just go sideways, your P&L is going to be the same. If you're an options trader, how do you want to trade that? Well, you trade it a little bit differently, right? Maybe I'll put on a call fly, and this is a little complicated, but just give you guys a little insight into the idea. But then maybe I'll do a 1x2. Why? Because if we go up here and pin these, well, that's perfect, right? These two will decay and die, and my long makes max value. Whereas if I did the 1x2 this way, and the market tanks, and then keeps going through, well, this is going to kill me. So I'm going to structure my position a little bit different as an options trader. And that's an advanced concept. I understand that. SpotGamma subscribers look at that, but if you're new here, a little food for thought on the way that you structure around the target that you think is going to happen. And Sherman, I think you are the last question. You've been very patient. I appreciate that. As we approach market close, won't the dealer's short calls likely get monetized, decreasing the strength of the charm and support? You ask a great question, and oftentimes the positions are closed. I would say it also depends on who the trader is. Captain Condor, who's a guy that we track often here because their positions can get pretty big, they interestingly don't close their position. So they'll leave it on. But as a general rule, right, if I'm playing a pin, I will typically take the pin trade off about 20 minutes to sometimes as much as half an hour before the close because I worry about positions suddenly shifting at the end of the day. In other words, let's say that I'm targeting the 63.50 strike and all day long it just does that. And I'm like, great, awesome. I'm probably going to close it out here. Why? Because in this last 5 or 10 minutes, if this guy closes or this guy closes or this girl closes, right? All of a sudden you could just get some noise and then suddenly your perfect pin just kind of snapped at the end of the day because of just end of day mechanics, right? So I don't like exposing myself generally to that kind of risk, right? So the answer to your question though is positions don't always get closed. I think that negative gamma positions do get closed more often than not. Why? Because you got to monetize that, right? Particularly put. If the market's crashing, the best time to close the put is in the middle of that crash, right? When that energy is really high. Um, in the positive gamma position, right, you want that decay to take place. You're willing to you can let the thing kind of run out. You're trying to collect that decay, right? So it's a little bit of a different trade, a little bit of a different session. All right, we are now at the top of the hour. I think I've gotten to all the questions. The dude, I'm glad you like this. I know a lot of you are big fans of JT, and I'm sorry you couldn't make it today. But my explanations were, quite frankly, better than his, so that I can talk some smack to him later. Matt mentioned a bunch of other tools. Just Matt, quickly, while I have the webinar page up, if you go to resources and you go to webinar replays, you will find the other Sharpen Your Skills sessions available in this, as well as the Q&As that I do. So for example, here's the Sharpen Your Skills on the Vol dashboard with the bearded JT, as well as a whole bunch of other excellent videos. I think they're excellent. So Matt, I'll pass it back over to you.
Okay, thanks, Brent. Thanks, everybody. We had more than 60 questions answered directly in the Q&A and many more in the chat. Appreciate you being with us. We try to keep it to an hour to respect your time. Just wanted to say what we've been doing from an educational perspective is Brent does these webinars Mondays and Thursdays, usually every week, except when traveling or something else comes up, does an OpEx focus for all subscribers. And new stuff, three things, these Sharpen Your Skills sessions. We'll do more of these. I know Brent loved being here today, but we'll have JT leading the majority of these going forward. And then three takeaways you're now seeing in the dashboard, which are 2 or 3 comments every day about what are the biggest takeaways from Brent's notes. So for those of you that are still learning how to digest Brent's language, which is usually for intermediate to expert traders, try to make that more accessible. And then we're actually working really hard on a full how to use SpotGamma course that will be free. It will be a couple, 2 to 3 hours long, probably. It'll go through every one of our products with explanations and examples. But when you sign up and go into our products, every product has a little I box on it with the green circle. If you click on that, there's usually a 2 to 3 minute video and a full text description how to use it. And in the upper right corner, there's also a how to use tutorial, which has checklists and trading strategies you could apply right now. So again, for subscribers and people that aren't with us yet, we're working on new products. We'll have 3 to 4 new products rolling out in the fourth quarter of this year, early fourth quarter. We're excited about. And then for people that aren't with us yet, again, we'd love you to take a chance, try a monthly, see how it goes for you. We really believe this adds exceptional edge, not just Trace, but all of our products. And again, try to make that visible at spotgamma.com syllabus or sharpen your skills. So thanks for all the kind words. Really appreciate everybody being with us and hope you have a great rest of the trading week. We'll see you soon. Thanks, Brent. Thanks, everybody.